Welcome to Hearts of Economy. Today, we're not just looking at headlines from a diplomatic meeting, we're unpacking something that could touch your wallet, your dinner table, and your investments directly. In Anchorage, Vladimir Putin and Donald Trump sat down for 3 hours. The headlines said no grand deal was reached, but behind those closed doors were discussions that could reshape the global economy. Energy prices, food supplies, investor risk appetite, Europe's future, NATO's financial burdens, all of these issues were on the table. And here is the point. For the markets, sometimes it's not the peace deal itself but the possibility of peace that shakes prices around the world. That's what we'll dive into today with numbers, scenarios, and expert voices. And I'll say this upfront. What you'll hear today, you won't get from the cable news talking heads, because we're not here to debate politics, we're here to understand how politics translates into economics. Energy is the heart of this war. Russia still produces close to 10 million barrels of oil a day and exports nearly half of it. Europe has cut its dependence on Russian gas from about 40% in 2022 to around 15% today, but it's still far from independent. Right after the Anchorage meeting, Brent crude briefly fell from $82 to $80 a barrel. Just a $2 drop, but in global trade that means hundreds of billions in savings. Oil isn't just a number on a chart. It runs through every part of the economy, from shipping to food prices. As economist Nouriel Roubini said just this month, every sustained jump in energy prices extends global inflation by at least another 6 months. In other words, if this war drags on, central banks will be forced to keep interest rates higher for longer. That ripples through credit markets, housing, business investment, everything. My own take, if peace gains traction, Brent could slide toward $70. That will cool global inflation. But if the talks stall and the conflict escalates, $100 oil is back on the table, and this time it wouldn't just be about gas at the pump, it could push the entire global economy toward recession. In Anchorage, they weren't just negotiating Ukraine, they were negotiating your energy bill. After energy comes food. Ukraine is normally one of the world's top grain exporters, shipping nearly 20 million tons of wheat a year. Since the war began, it's lost about 40% of that capacity. The Black Sea grain corridor has been opened, closed, and reopened multiple times. The results have been felt in kitchens worldwide. According to World Bank, global wheat prices rose 35% in the first year of the war. Bread prices doubled in Egypt. Over 100 million people in sub-Saharan Africa were pushed closer to hunger. If peace takes hold, what prices could fall by 15%? That's not just about the cost of a loaf of bread, it's about political stability. Food crises have a way of fueling migration, protests, and regime change. As Nobel laureate Paul Krugman put it, in economics, sometimes the most powerful weapons aren't tanks, they're grain silos. And he is right. At the table in Anchorage, land was discussed, but so was bread. Now let's get to the core of Wall Street's question. Who wins? Who loses if peace happens? Markets have already spoken. The MSCI Emerging Markets Index rose 1% right after the meeting. Doesn't sound huge, but this signals tens of billions of dollars flowing into riskier assets. Gold, on the other hand, dipped from $2,362 to $2,345 an ounce. Safe haven demand is already softening. If peace materializes, analysts say gold could fall to $2,200 But if the war escalates, $2,500 plus is on the horizon. Defense stocks? Look at Martin's shares are up nearly 40% since the war began. Those gains are at risk in a peace scenario. Meanwhile, agriculture and logistics companies will be the new winners. Economist Jeffrey Sachs once said, "There is a stock market for war, and there is a stock market for peace. The winners are always the ones who position early." And I agree. Right now, the smartest move for investors is diversification, because only certainty is uncertainty. Peace and war are both priced in. Let's look at two main players' economies. Russia's official 2025 growth forecast is about 1.4%. Thanks to energy exports, it's keeping its budget deficit under 2%. But the cracks are showing. Tech imports are restricted, capital outflows are accelerating, and consumer electronics have been gutted with Apple, Samsung, and Intel gone. Ukraine's picture is far worse. Its economy has contracted about 22% since 2022. The IMF estimates rebuilding will require at least $400 billion. That's why the new US-Ukraine Mineral Resources Agreement is so controversial. Under the deal, Ukraine is expected to share 50% of its mineral revenues with Washington in exchange for investment. Some call it salvation, others call it surrender. Here's my view. For Ukraine, peace is not just about territory, it's about survival. Without peace, the economy won't just struggle, it will remain entirely dependent on foreign aid, unable to stand on its own. We usually hear the three standard scenarios: peace, frozen conflict, or escalation. But let's talk about the less obvious ones. Scenario 1. Trump partially pulls back from NATO. That will force Europe to shoulder its own defense budgets. Germany has already earmarked $110 billion for defense spending by 2026. That could drive Europe into a mild recession, not because of war, but because of defense bills. Scenario 2. China steps in more aggressively. Beijing has already ramped up oil imports from Russia. If peace fails, China could leverage energy markets to its advantage, shifting to balance in the US-China rivalry. Scenario 3. False flag events. Whether in Ukraine or the Baltic, a staged provocation could send markets into shock. Investors are pricing that risk too. It's not just peace or war, it's the gray zones in between that matter. This is why, in my view, investors shouldn't just prepare for the black and white scenarios. The in-betweens are where the real volatility lives. So let's bring this together. The encouraged talks didn't deliver a grand bargain, but they already moved markets. Energy dipped, food futures shifted, stocks reacted. And that tells us something vital. In today's economy, the possibility of peace is as powerful as peace itself. Markets don't wait for treaties, they trade on probabilities. What I want you to take away is this: every dollar in your gas bill, every loaf of bread in your kitchen, every line on your investment portfolio, it's all tied to negotiations happening thousands of miles away. Here at Heart of Economy, we don't stop at the headlines. We break down how those headlines reach into your life and your future. So if you want to keep seeing the world through the lens of finance, make sure you subscribe. And remember, sometimes it's not the war itself, or even the peace itself, but just the chance of either one that reshapes the global economy. And we'll keep decoding every one of those chances for you. Stay tuned. See you in the next time.